Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Chief Investment Officer, Equity Armor Investments, with reaction to the CPI data. We'll also talk some technical levels in the Nasdaq 100 as well. Brian, it's great to see you as always. Welcome back to Trade Talks. Saw a slight uptick in CPI data this month. Do you think this is going to impact the strategy that the Fed currently has? Are we going to pause, have another rate cut? Another rate hike?
Yeah. Well, when we look at the what the Fed governor from San Francisco said earlier today, actually, the markets rallied pretty strongly because they took a look at the CPI number, and the month-over-month data on the core number of 0.2% really wasn't, anything significant. Actually, if you extrapolate that out, that's basically the 2% where the Fed wants us to get to year over year. But we did see the Fed governor of San Francisco come out and say, hey, the Fed still has a lot more work to be done here. So certainly easing is definitely not in the cards. Maybe holding steady and having things work itself off could be, but certainly, we're still getting rising inflation numbers here. So it's a question of, yeah, maybe they'll take a pause at the next meeting, but is there more work to be done thereafter? And that's when we saw the market start to sell off today.
But when you dig deeper into the data, the shelter index is unforgivingly stubborn, right? And food and prices are elevated. Gas prices, certainly where I live, are up 20 to 40 cents, let's call it. It feels very inflationary, I think, to the average consumer.
Yeah, it does, actually. The average consumer has definitely been feeling the pinch. And, when we see inflation the way it's been over the last couple of years, sort of continuing to expand, the Fed is comfortable just basically being 2% from there on after. But what about that huge rise that we've seen over the last couple of years? That's really affected the consumer. However, we are starting to see some tick ups in some of these consumer discretionary type stocks in recent earnings that might be indicating, some of this can sort of get worked off. And maybe the Fed is kind of right on a soft landing-ish kind of style.
Let's take a look at technicals for a moment here. What's your latest on the Nasdaq?
Yeah, it's kind of interesting. We saw sort of the markets break down in the Nasdaq. 15,540 was sort of this low point in the middle of July, and then we broke down below that sort of to start August. And so that area seems going to be a resistance going forward back on the upside. It feels like 15,000 is really the magnet, and the reason being is these big round huge whole numbers. Option traders like to trade around that number, and they tend to act as a big magnet for the market. So it really feels like any sort of rally gets sold in the Nasdaq probably until we hit below 15,100. Around that 15,000 level is probably an area where you'd probably find support again.
What about earnings? What were your thoughts on that? They seemed okay, right? We know the major Nasdaq 100 names have reported. What was your overall take on it?
Well, they were okay. The one thing that was maybe glaring and maybe a little concerning was Apple's earnings, right? We saw the stock sell off of that. If you look at forward PE over the next, let's say, 12 months, the multiples on Apple are a little bit on the high side. And as you know, Apple's such a big weighting in the Nasdaq 100 and the S&P 500 for that matter. So certainly any sort of selling pressure that comes from Apple is probably going to affect the markets to some degree. And it feels like it's not that Apple isn't a good investment. It just might be an area where it needs to take a pause for a little while, have some earning couple quarters go by to catch up so that those multiples come down. We in particular, as we sort of look for value in these sort of tech kind of names, really prefer, when you looked at Google's earnings, those were fantastic. Amazon, a couple like the cloud computing, more AI shift is an area where I would look to find value and continued growth in those earnings numbers.
And when you think about growth tech names, Nasdaq names, what's the line in the sand when it comes to the 10-year?
Yeah, I mean, when you look at the Nasdaq, it really is fairly sensitive to that 10-year interest rate note. And I think the line in the sand, like you're asking here, is probably 4.25%. It really has had a tough time even getting above 4.1. It seems like Treasury buyers come into the market anytime the 10-year sort of gets up to that level, and there's pretty big support. But 4.25% is the level I'd be really concerned in watching, because there's really not much. If you go back to data, even going back 25 years, let's say, there's not much resistance above 4.25%. We could see the 10-year get to 5. I think that's what ultimately cracks the market, or maybe even causes a recession down the road, if the 10-year sort of spikes above that level, because that'll be a tremendous amount of pressure on growthy kind of tech names, which is so heavily weighted in the Nasdaq. So watch that level.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.